Hello and welcome back to another episode of the Retire Once Show. I'm your host, Johnathan Rankin, the founder and CEO of Theorem Wealth Management. Very happy to be here. We are in the midst of summer. The fun heat is upon us. And today we're going to be talking about setting yourself up for retirement success, both financially and mentally. And we know that's a big part of it. But before we jump into any of that, Mel, what do we want people to do?
We want you to subscribe. We want you to never miss one of these amazing episodes or, our take on the weather.
That's right. Take on the weather and our weekly retirement newsletter.
Absolutely.
Comes out every Friday. So make sure you hit the subscribe button, join the newsletter, join the show. We're happy to be here. And yeah, our take on the weather. I mean, it's hot. I did see some reprieve for that with Costco now coming out with their Halloween stuff. They started putting that out on the shelves. So
it's hard to think about like face painting or anything like that, or walking around in a full-blown costume, even with the kids. Just walking around the block, I can't even imagine that when it's this hot out.
Yeah, I feel like this is the one thing that makes me feel older and older every single year is I complain louder and louder about how early they're actually starting to put things on shelves.
But, come on, it's super early for
October.
We're in
July, and now we're putting out Halloween stuff, and it's just, we just know Labor Day is coming, which means Christmas stuff, holiday stuff is going to be on the shelves, and we're going to be complaining. But then you realize there are still people out there that October 31st are putting together a homemade costume for their kids because they couldn't make it to the store over the past 4 months. The Target.
They had a little bit of time, is what you're saying.
They had a little bit of time. I mean, if you're the store, whether you're Target, Walmart, Costco, you name it, they're thinking, hey, look, we gave you 4 months. How long do you need? I mean, if you can't get a costume or some Christmas gifts by then, I don't know what it's going to take. So
just like we don't want you to be unprepared for, any time of year, Halloween, Christmas, or whatever, we also don't want you to be unprepared for retirement.
That's right. So
we'll bring it right back on track.
Let's dive right in. First thing we want to talk about today is an article that I came across. The title of the article was "Your Standard of Living in Retirement is Largely Determined by This Surprising Thing." I wonder what it is.
Surprising.
Very surprising. And they talked about the single biggest detriment having more importance than all other factors combined is the performance of the stock and bond markets.
Uh-huh.
Yeah.
Right?
Okay. I understand that. That makes sense. I don't think the article title was a little bit more deceiving.
Oh, I was like, that was the surprising part?
That was the surprising part, is that the performance of the stock and bond markets are going to basically determine your standard of living. Yes, everything that we do for retirement, whether it's nowadays or even going back when there were pensions, had some sort of rate of return that was needed to achieve that success. But the problem with that is that you have no control. So
it's really out of your hands.
So I don't know if the article was talking about, hey, well, retirement success is out of your hands, which I don't think neither one of us believe.
It is. I mean, yeah, I guess is kind of
either way. It shows this chart that we'll put up on the screen here shows how close the correlation is between stock and bond markets, and on the other hand, the return of retirement portfolios, and they move in lockstep, which
shocking
kind of makes sense simply because, as we've progressed, especially over these years, the more and more, I would say, use of target date funds has been, which brings people closer to that 60-40 portfolio. But why I bring all this up? Because yes, we all know market performance is going to dictate standard of livings in retirement at some point. If most people aren't retiring from cash that they just saved in their bank, even
or under the mattress or whatever.
Who does that?
I don't know, but they always say that.
Do people do that? And Breaking Bad does that.
Oh yeah.
But you're not. I don't think anybody's running a Breaking Bad scheme. If you are, you're probably not watching this or listening to this. So
you're probably not concerned about your retirement, honestly.
No, I don't. Okay, so the reason why I brought this up is because the author had these very interesting market forecasts. So his forecast for the bond market over the next 10 years, he's expecting a 4.8% rate of return.
Okay,
sounds pretty good.
Mm-hmm.
4.8% in bonds would be nice. A lot more than what we got from 2009 through last year. So pretty great return. Stocks, on the other hand, uses 8 indicators, and he's expecting a nominal rate of return of an annual rate of 1.3% between now and 2033.
1.3%.
1.3%. So in total, the 60/40 portfolio would deliver a 2.7% annualized rate of return. Now, we talked about, the 60/40 portfolio before. Is it, still relevant? You name it. Now, I think anything with returns like that, might be a little challenging.
Which is interesting because I actually came across a 2023 Natixis Global Survey of individual investors who expected an annual return of over 15.6%, which is down from the exceedingly high 17.5%.
Yeah, I would love to have a conversation with the individual investors who were expecting a 17.5% rate of return, but even 15.6%.
That's still really high.
So on one hand, you have investor expectations, and then you have a market forecaster and his
2.7.
So somewhere in the middle, there's
it's a big range.
There is. My favorite part about this article is that he pointed out that since 1793, the U.S. stock market average rate of return has been 6.1% annualized, and the long-term treasury rate has been about 4% annualized. So those are the rates of return going back to 1793.
1793.
Very relevant.
I was going to say, I feel like he's just throwing numbers out there then.
Very relevant. I really, there's got to be a cap on when statistics can just be over, no longer relevant.
1793, you're kind of like, okay, that.
I feel like the 1700s, we just wipe any of those statistics. I feel like the 1800s, there's got to be.
Yeah, 1800s even.
I think like a rolling 80-year period.
Like keep it relevant.
It's got to be somewhat relevant.
Yeah, a little more timely. 1793.
Yeah, because they're just 1793 is not relevant.
It is, but it isn't.
I think that like 1910 is still not really relevant, but we use it. It feels like
even that feels a little bit more relevant than and dating back to 1793.
Yeah, like I said, I think like a good 70, 80 years is a good generational period, but that's just my take on it. But there was an interesting chart by Davis Advisors that showed the worst 10-year periods for stocks. And I wanted to find this because I was wondering, okay, how realistic is this guy's forecast? Is there a possibility that he's right? We've obviously know that over a course of a 10-year period, the odds of having growth is going to be goes up as you get longer in the tooth, but it did show the worst 10-year period. So we had 29 through 1938 at negative 1.7%. Makes sense.
Right.
We've got the Great Depression there. 1930 through 1939, basically flat. Okay, that makes sense. 65 through 74, 1.2%. And then most recently, which we'll actually use as a barometer, 2002 to 2011 or 2011, 2.9% rate of return. So there have been periods of a 10-year underperformance. So just because over the last 10 years we've had pretty good performance doesn't necessarily mean the next 10 years are going to be great, or that stocks over the course of a 10-year period do well. But most people, they're not planning for a 10-year retirement, I wouldn't think.
I wouldn't hope.
I would hope. And so, what about 20 years? I think
a little more realistic.
And so found this chart by Crestmont Research going back to 1919. So
okay,
still in my relevant window.
Thank God.
I'm going to use 1910 as relevancy here just for my sake. Now, this shows all 20-year periods have been positive. So that's good.
That's good.
The lowest rate of return on average for a 30-year period or 20-year period was 2%, a little less than that, and that was ending in 1949. Now, you have to think, that included the Great Depression, World War II. To me, that makes sense.
That tracks.
Now, aside from that, the annualized return average was between 5.1% up to 15.4%.
Okay, now that's pretty good.
So back to the expectations in the statistics survey, there have been times where there's been a 20-year period where
it's happened.
Yeah, 15.4% has happened. So,
but that 17.5 is still way out there.
Way out there. Almost 90% of the time, the annual returns were 7% or higher. So that's a nice solid rate of return 90% of the time. Now, people, like I said, they're not planning a 10-year retirement, hopefully not a 20-year retirement. We didn't even talk about 30 years.
We didn't even get into that.
Because over a 30-year period, the worst 30-year return was a total gain of a whopping only 850%.
Only
850%. And that's going back to 1926.
Still in the time.
Still in the time. That's right. Still in my relevancy period. The annual return was 7.8%. Now, this included the peak you bought, basically at the peak of the roaring 20s. So you had that big boom. You're buying right at the peak of that. And at one point, you would have lost more than 80% of your investment and still made only 850%.
Still. I mean, it makes you wonder how many people would have actually held on during that time.
I mean, you get to that point where once you're down, I would say around over 80%, you just go, well, what am I going to do by cashing it out? I mean, you think of if you had $100 and it's down to 15, you kind of go, what's $15 going to do this? What am I going to cash this out?
I'll just leave it there.
Yeah, but I think aside from just holding, and we've seen this happen with large tech companies, whether it's Amazon or Apple, where they've had periods of these major corrections, and obviously they've done quite well for themselves. I think Apple's doing okay these days.
I think so.
But not just if you held. I think about, could you have kept buying? You know, we talk about, before in previous episodes, how a big part of retirement is just continuing to buy. You know, how people have stopped their contributions, have reduced their contributions because of bad times in the economy. We've seen that. Well, if you've gone through Great Depression, World War II, and, my guess is that what else happened between 1926 and 1956? My guess is a lot of other things happened that probably weren't the most positive headlines. Could you have continued to contribute to your retirement? And I think all of this just at least shows me that there's always headlines and things that are going to be bad.
Always.
We talked about this before. You can't control that. Remember last year it was, this war in Ukraine's going to, it's going to cause everything to global meltdown. It's
going to affect us.
It's going to affect everything. Yep. But yet now we have oil prices back below their all-time highs, well off their all-time highs. We've, had the market recover to a certain degree. So, this is not about trying to time anything or
you really can't.
No, you focus on what you can control. I think if you take anything away from what I take away from this article was focus on what you can control. You can't control what the stock market's going to do. And if this guy's right and we have another 10-year number of, what do you say, 1 point
something.
2.7% would be the total 60-40 annualized rate of return. So 2.7%. And if you get 2.7% over the next 10 years, all right, well, one thing is for sure, you have to continue to contribute.
And you might want to start putting in a little bit more.
Yeah.
Just if you can.
Yeah. If you can save more, that, at least get up to that match, because that's going to help you.
Yes.
So focus on what you control, which is saving, your spending, and then how often you're planning, because we're going to have periods of underperformance. We're going to go through bear markets and recessions. And guess what? We talked about it last year. Next year, do you know what next year is? Oh, I'm so excited. It's a presidential election.
Oh, right.
So the questions are coming. It's kind of like right now it's July and Costco's coming out with their Halloween stuff. So come Labor Day, they're going to start rolling out their Christmas stuff. Mm-hmm. Come November, the questions are going to start coming in. How's the presidential election going to impact the markets?
It always happens.
Always happens. Every 2 years because of the midterms, but every 4 years for sure. So
for sure.
Looking forward to getting to that one. But just in advance, a spoiler alert, don't sell all your investments because of whoever is going to be running or sitting in the presidential office. There's no need. I just wouldn't do it.
No.
Don't do it. Not good advice.
No, don't do that.
No, do not sell all of your investments because there's a presidential election coming up next year.
Absolutely.
So that's, but let's move on because.
I was going to say, let's shift away from that a little bit.
No, we're going to go to a much more uplifting segment here because retirement is about more than money. And we've talked about this before, how we want people to live a fulfilled life in retirement. And that is once you hit that number of, okay, I've got my, monthly distribution or I've got my income taken care of. I don't need to worry about money anymore. Does that mean you're going to live a happy retirement? And
not necessarily.
No, we've seen very wealthy people have miserable retirements. Now, they're not going to say it's miserable.
Right. I was going to say, I don't think people come right out and say that part.
No, but they tell us, that's fine. You just get a different vibe, different attitude from them when you're having conversations before when they were working. So we've seen it. People often find themselves lost, and we've talked about how gray divorce is on the rise. So that's why I feel like we got to talk about how to create a fulfilling retirement.
Which is funny and kind of crazy that you say that, because I came across an article about Steve and his wife Karen. They recently retired, but it jumped out at me because we have discovered we each need to a cave to call our own in retirement. So it's like they want to be together, but they still need their own space.
Yeah, I can see that.
I mean, that makes sense. I think that would probably help avoid some of those gray divorces.
Yeah, and I love the quote from the article. If we did anything right to prepare for retirement together, it was to build out caves where we can be apart.
I like that they call them caves. I don't know why. Just picture a little cave, dark room.
The funny thing, you've heard the term man cave before, and I guess that Karen was looking for
I also want my cave.
I think she called it a she den. Or because if she tried to type in woman cave, it didn't come up. Nope, but
it's only a man cave.
She den came up, but they love to spend time together, but they do need their space where they could be alone, because as they talk about, the first year of retirement is often the most difficult, the biggest transition.
As is the first year of marriage.
I wouldn't say that about the Rankin household, but hey, that's just me. This is one side.
Our first year was wedded bliss, is what he means. So
I'm getting grays. I don't want to have a gray divorce.
I don't either. I don't think anybody sets out to have one.
No, I don't think so either. But one of the things that they talked about in the article that was this older article that was titled, "Why Too Much Togetherness Can Ruin Retirement." And it was this concept of parallel play. Now, I love that they used in this article, and we'll link to all this in the show notes. To me, they used the worst analogy ever. And I want to read this
You
verbatim.
were really bothered by this.
I really was. It says, try watching two children in a sandbox, a boy playing with toy trucks and a girl using a pail and shovel to build sandcastles. Chances are that the toddlers will be quite content. They'll be next to each other or moving further apart, silent at times and babbling to themselves or each other at other times. They will no doubt resolve minor disagreements if they occur, whereas they would probably be fighting if they tried to play with the same toy in that sandbox. They clearly don't have children.
I was going to say, yeah, they've never witnessed two children play together.
As parents of a 5 and a 6-year-old, no matter what, they could be playing with their separate toys. If they're in the same sandbox, they're going to fight about each other's toys.
No matter what.
No matter what.
Without question.
Now, if we're doing something wrong, if our kids are the outlier there and they're not supposed to be fighting, please send us an email and tell us, how could we fix that?
Yeah, or I was going to say, if you know how to prevent that.
Yeah, but
we're open to that as well.
I get the point. They're talking about this concept of parallel play where individuals who they want to have their own space, their own interests, their own things to do, because there have been studies that showed that people who do everything together, who are joined at the hip, are usually unsatisfied or unfulfilled as couples, whereas spouses that do have their own interests and have new skills that they're developing, they're a lot happier. And so, I think bringing this up in this retirement show is really about creating that retirement happiness. And as you're thinking about going into retirement, if you're married, then it's something that you need to start planning for, that you're going to be spending a lot more time with your spouse.
You need to be thinking about your cave.
That's right. Build out your cave or your she den.
I think they should just both be called caves.
You want the Mel cave?
Well, I just think it should just be cave. Just, it doesn't have to be man cave, but
just cave.
I digress. Okay, back
Either way, find your space, but think about, in the first part we were talking about, okay, how are you going to invest? What are you going to invest in? How's the market going to do? But that aside, you can't control that, but you can control, all right, what's your plan for what are you going to do in retirement? How are you going to spend this time? How are you and your spouse or your partner going to spend this time together to make sure that you're both happy? Because,
absolutely.
I love you, but if we had to spend every day together, I think you'd grow tired of me. I would never grow tired of you.
No, I think it would be tough. I think it would be tough.
I would be perfectly happy and content.
All right.
I would be so happy. That is my dream when I think about my retirement, is just to follow you around.
Joined at the hip.
To be joined at the hip. But make sure you're thinking about these things as you're planning your retirement, because we want you to live a happy life. happy retirement, and really be fulfilled. And think about retirement as more than money. And that's the biggest takeaway.
It is more than money.
It is. Once you get that solved, there's only so many times you can solve how much you need for retirement and when you're going to take Social Security and all those other financial concepts. And
once that's all answered,
you still have to spend time with your spouse.
Fill the days.
That's right. So think about those things. And while you're at it, while you're thinking about those things, what do we want you to do?
We want you to subscribe.
That's right. Hit that subscribe button. Make sure you subscribe to our weekly retirement newsletter. And with that, I'm Johnathan Rankin.
And I'm Melissa Rankin. Thank you so much for joining us.